Hi all, I recently attended a fantastic presentation by Keith Cunningham, and he was talking to us about accounting for entrepreneurs. And even though it sounds extremely boring, he made it fun, he made it clear and very, very simple. I asked a couple of my LinkedIn connections whether they would like a video about it, and many said yes. So today I'm going to walk you through that presentation and a couple of key principles. Business is a game. And any game has a specific language for it. For instance, if you play basketball, or if you play American football, or if you play cricket, you have completely different terminology to determine certain things. It has rules and it has language. Business is very, very similar. It also has a specific language, and the language of business is accounting. The thing is, if you do not know the language of business, you will not be able to understand what's going on, and you will not be able to even tell losers from winners. I'm going to show you an example, and this is the scoreboard of cricket. A very cool game. A lot of people in the UK are playing, and in India are playing, and you can see this is the scoreboard. People that are not familiar with cricket, looking at that, will not even be able to understand who are the winners, who are the losers, and what's going on. So that happens in business exactly. If you do not understand your dashboards, you will not basically excel. And the language of business is accounting, and there are 3 dashboards and scoreboards that you as business owner must understand. Before that, we're going to look at our let's say flow, success flow. This was also extremely interesting. So basically that's how a business goes, right? There is management. Management makes decisions. Decisions are translated into actions, and then actions in your business are translated into numbers, right? So management gives the direction, we decide, we act on it, introduce a new product, moving ahead with a certain service, or reinstalling a system, and then it moves into numbers. If it is good management, good decision, it turns into good activities and good numbers. If the numbers are bad, that means the activities were shitty, decisions were shitty, and that means the management was also shitty. Very interesting to understand is that the job of accountant is to translate activities, what happened in the business, into numbers. And the job of a business owner is to translate numbers into activities. To understand this is our performance. How do I actually take that, translate it into activities, change the activities, and basically improve the numbers? If you do not change the activities, the numbers will not improve, right? So change the activities, change the numbers. We go into the 3 very important dashboards of accounting. There are 3 of them, and you definitely heard about all of them. Number 1 is balance sheet. Right? So this long piece of paper that your accountant gives you, balance sheet. The second type of scoreboard that accounting, the language of business, offers you is called income statement. And the last one is called statement of cash flow. So 3 scoreboards of business. Most of the business people jump straight to the income statement because they want to see what is the profit. Right? So when I used to receive my accounting things, I would also jump straight to that. And right now I understand that this is not a good idea. So you need to actually look at all 3 papers. Let's take a look at what those papers are and how to make sense out of them. So here is the balance sheet. Here's how the balance sheet looks. And it's very, very simple. We don't overcomplicate it. First thing here, first column here is all your things and stuff. All your things and all your stuff. What kind of things and stuff does a business have? Firstly, it's cash. Cash is the most important thing and stuff that you as a business must have. Number 2 is accounts receivable. So if your customers have not paid you yet, but they owe you money, basically that's accounts receivable. The next one is inventory, right? So you bought a printer, or for instance, you are a lemonade maker and you buy tons of lemons to make lemonade, to produce that stuff, right? So this is your inventory. And then there is PPE, which is property, plant, and equipment. Yeah, so all these things here. On the other side, here you've got things that you owe, and here are the things that you own. So the things that you owe to somebody else are called liabilities. For example, accounts payable. You need to pay your suppliers, you need to pay somebody, but you haven't done that yet. Then there are taxes, right? And of course there are rates. If you borrowed money from a bank or institution and you need to pay that money out, this is the rate. Then there is equity. There are only two things that business owns, two things, and this is called equity. Number one, the investment. If I invest in my company, business owns it, that's investment. Number two, your profit and earnings. And the profit and earnings can be distributed to shareholders, or profit and earnings can be kept in the business, right? So why is it called balance sheet? Because if here I have liabilities that are 60 and here I have equity, which is let's say $40, then my assets must be $100. So the two sides always balance out. Let's take a look at the second dashboard of business, which is called the income statement, or many people know it as P&L. Let's take a look at P&L. Very straightforward. There is sales, revenue, turnover, and minus expenses. And then we have our basically bottom line with profit, net income, and earnings. For instance, if you're making lemonade and you sold for $100 and then your expenses were 60, then obviously your profit, net income, earnings are $40, right? In terms of income statement, we need to understand that profit as a concept is actually a theory. Why? Because you cannot spend your profit. You can only spend your cash. Your profit is what your business could be in a couple of, let's say, weeks or months from now. But people have not paid you. You have not paid people. It is a theory of what you could be. So if we look at our let's say balance sheet, this is a snapshot. It's like if we are shooting a movie. This is a picture, just one snapshot, because it is as of a certain date. So the balance sheet means today, on the 1st of September, this is how well Ashley's company is doing. This is how much liabilities, equity, and assets she has. It doesn't tell me why or how did we get here. When we look at our profit and loss statement, this is not a snapshot. It is actually a movie. So it tells us from this date to this day, for example, for the period of 6 months or 12 months, Ashley's company, total sales, total expenses, is this. And that's what the theory for the profits is. So profit is a theory, right? That's how much money we potentially made. But whether or not we made this money will be reflected only in the last sheet, which is statement of cash flow. You cannot spend your profit. You can only spend the actual cash. So this is an extremely important final statement. It's called statement of cash flow. And here you've got 3 types of cash. Number one is operational cash. Operational cash. So this is cash generated by business. For example, paying bills, right? It can be plus, negative, and positive. Negative, for example, I'm paying some bills, right? This is my operational cash flow, something that helps me do business. And it can be positive. My clients pay me, so I receive money from the clients. The second type of cash is called investing cash flow. So that investing cash flow happens, for example, negative when I invest in something, and positive, for example, when I sell my used car and I get this money coming in. So my kind of investment coming back. When I sell fixed assets most of the times. And then there is financing cash flow. Financing cash flow happens positively, comes into your company with investment, right? And of course, negative, when you need to repay the rate, when you need to repay your investors. So these are 3 types of cash flow. And as you can see, operating cash flow, investing cash flow, and financial cash flow are not created alike. The most important cash flow is obviously operating cash flow, right? And the balance sheet does not put a distinction of where does the money come from. It just tells you cash. But here you can exactly see how well your business is doing. And cash is not a theory. It is a fact. So this statement of cash flow is also a fact. And it tells you how did you get there. It is not a snapshot, yeah, it's also a movie. So it basically tells you from this time to this time, that's how much money Ashley's company has made. So now this is where the magic happens. This is the whole accounting for managers. Let's take a look at this. The first one is the balance sheet. And you will see here we have our assets, or we call it things and stuff. The most important things and stuff is your cash. Here it is. Your cash is the most important. And then all the other things and stuff that you have. Here we have the things that we owe. Yeah, so our liabilities, a list of liabilities. Then we have things that we own. Yeah, these are our profits. Yeah, and these are our investments. Then we have another sheet, which is the profit and loss statement, right? So P&L, we look at the sales, we look at the expenses, and we look at the bottom line, which is the profit. So these, how do these sheets come together? This amount here, which is the earnings, is exactly the amount that goes here, right? So these are the earnings. Then we have another sheet, which is statement of cash flow. We've got our operating cash, we've got our investing cash, we've got our financial cash, we've got total cash flow, yeah, plus minus. We've got our total cash flow in here. And this cash flow goes directly into things and stuff, into our balance sheet. So this is the accounting for business that everyone and anyone needs to understand. Cash flow is the key. This is your most important statement. Are you making money? This is a fact. This is not a theory. Profit is a theory. You need to understand all three of those dashboards and how they come together. You don't need to be an accountant. A lot of business owners feel that they need to be accountants, but you need to understand what your accountant is doing in order to be able to translate those activities, these dashboards, into managerial decisions. You need to be able to read that rugby or cricket dashboard to tell winners from the losers. What are the losing activities? What are the winning activities? And this is a very simple way to basically explain it. And that's what you can request from your accountant. They give you the numbers. You look at the numbers and you make decisions. You don't need to be an accountant yourself, but you need to understand it all. And remember, management makes decisions. Good decisions lead to good actions, and good actions lead to good numbers, right? So the job of accountant is to translate activities into numbers, and your job is to translate numbers into activities. Now, I hope you learned a lot, and I hope you're gonna go and get them all. This is accounting. Keith Cunningham has done an amazing job. I have taught my team those things. They loved it, and right now we're implementing it in our business and changing the way we communicate our financial statements, because we were very scared of them, and we really wanted to just look at profit and then shuffle it down and put it away. This is important to understand. And what can you do out of it? A lot of people also ask. First of all, you need to clean up your dashboards. You need to really make sure that you look at those things regularly, you understand them, and you direct your accountant to give you that stuff. Secondly, because operating cash flow, because cash flow is the most important thing, you need to work consistently on increasing that cash flow. And there are three things you can do. Number one thing you can do to increase your cash flow is you need to have less cost. So for instance, in my business, it's an agency business, it's a training business, so it's all about people. I don't have factories, I don't have plants, I don't have equipment, but I have people. So the less people I have, the lower my cost. So make sure you're doing the most with the least people. Secondly, you need to get money up front. So make sure that you don't have a lot of money that customers owe you. Request them to prepay 70% or 100%. Yeah, the bigger, the stronger you become, the more relationships you have with them. Ask them to prepay. Do not accept delayed payments or charge them really heavy fees for that kind of stuff. Get your money in first. Cash. Profit is a theory, cash is a fact. And number three thing you can do is when you pay suppliers, you need to negotiate the terms when you can pay, let's say 1 month later or 2 months later. In my business, it used to be so that our clients used to pay us with delay, let's say 2 weeks, 3 weeks, 4 weeks with delay after we provided the service. right? If it is a retainer marketing agreement or it's a training, so 50% in advance, 50% a month after. So that drains your cash flow, drains it. And I used to pay all our suppliers the day they sent out their invoice. So that's really screwed up, yeah? Make sure that clients pay you first, you pay your suppliers a bit later, and make sure you cut the costs. So this is the way to keep your cash flow up and work on it consistently. I hope you enjoyed, and thank you very much for watching.